And welcome to the CryptoCannaVerse, an international faith-based show where we help entrepreneurs within Christ, cannabis, cryptocurrency, and CPAs. Our goal is to educate, grow, and inspire while connecting founders with investors, advisors, and partnerships. All faiths are welcome, hosted by Crystal Wampler and Alan Lau. And our guest co-host today is Jeff Embry, managing partner of the crypto hedge fund Globe 3 Capital. Welcome, Jeff.
Thank you for having me, Crystal. Great to be with all of you.
Wonderful having you here. Jeff, can you tell us a little bit about your background and how you got into crypto and what you're doing?
Sure, I'd be more than happy to. Globe 3 Capital launched in July of 2022. I came from a background of about 16 years in private money management, high net worth and ultra high net worth. Worked for a gentleman that most people are familiar with, Ken Fisher, one of the most successful business people on the planet. And he is a study of global macro, top-down, market cycle, economics, politics, capitalism, and all the layers of all three of those or four of those combined. So that's my expertise that I bring to Globe 3 Capital, understanding how market cycles work. My partner, who I met in college and one of my best friends at San Diego State, go Aztecs, he became a crypto expert about 8 years ago. So we saw as the equity markets were declining in a bear market in early 2022 and the crypto markets were collapsing, that a strong bear market was in place. And we knew if we were ever going to launch a crypto hedge fund, we should be launching at or near the bottom of a bear market. No one ever calls a bear market correctly. So if you can get in at or near, you've solved 70 to 80% of the equation for both yourself and your limited partners, LPs. We saw that opportunity. We said we'll get 2017 pricing for 2022 market adoption and technological advances, something that doesn't come around often, as well as this amazing new iteration we call Web3 or digital assets that is going to change and revolutionize the internet as much as the internet did itself. So we jumped in full force as fast as we could. Now we look back, we saw we were a little early to the bottom of the bear market, launching in July of 2022. But of course, you'd rather be early than late. We have taken advantage and we said we need to do two things correctly to have a successful fund. We have to be unique and we have to be right. Now we're proven right with this new bull market that most people are just starting to recognize. We think it'll be a powerful crypto bull market in 2024. And by being unique quickly, we are long only. We do not short. We do not collateralize. We do not use derivatives. We don't need to take on any extra risk, but we do identify most liquid tokens in the small and micro cap space. So we don't invest in Bitcoin or Ethereum. We invest in the smaller coins. We recommend people do that. We think they're going to do fantastic. We just believe we will be able to exponential those two tokens with the smaller market caps that are the railroads, toll roads, and future of Web3. So that's us in a nutshell. And quickly, our minimum is $100,000. We set it up for friends and family and the next kind of concentric circle outside of that. And now we're starting to get institutional attraction because of our performance and ability to navigate these markets.
That's wonderful. Congratulations on getting institutional traction. You know, I'm just kind of curious, what is your maximum investment opportunity?
Our maximum would probably be, I would say 10 million. So I don't think we're at that stage yet, but we would certainly welcome it.
How much AUM can you handle?
Actually 10 million. So we set this up. One, we need to do it quickly. Two, just US domiciled. Three, it was designed for friends and family at the beginning. And so the easiest registration was a 506B. Patrick would be familiar with that, where we can allow just 100 of the limited partners LPs into our fund. With our minimum being 100,000, we said, let's just cap it at 10 million. One, we invest in smaller and micro cap tokens. So we really can't be a $50, $100 million fund. We can certainly grow into it and we will, but we didn't want to set it up that big. So we wanted to stay small, wanted to stay nimble. We knew it would be challenging to just get to that first 10 million, and that's where we are. Oh, and
That's
one other
wonderful.
thing. Yeah, one other thing, if I can add, Crystal. 2 months ago, we just brought on an IRA partner, an IRA fund administrator that facilitates IRA investments. So for the first time, we've been able to accept Roth IRAs, SEP IRAs, traditional IRAs, and Benny IRAs into our fund. And we think it's a game changer, avoiding the taxation and staying like titled in the IRA format and tax deferred.
That is wonderful. Thank
Yeah.
you. That was actually my next question. So you beat me to it. Does anybody else have any questions for Jeff? Not at the moment. Jeff, where can people reach you?
We're really active in LinkedIn. We do have a website where they'd be able to fill in their phone number and questions or contact information at www.globe3capital.com. But best to find Jeff Embry or my partner Matt Layson on LinkedIn or our webpage on LinkedIn at Globe3 Capital. And happy to start a conversation anytime. We often say it's a lonely space in crypto. There aren't a lot of people to talk to about it. So we just absolutely eat up any conversations we can have. It's fun to educate people, but it's also pretty exciting knowing that we're all so early, on this call that there just aren't a ton of people that can engage in even the highest level of conversations.
Wonderful. Thank you, Jeff. Just to let you all know, the CryptoCannaVerse show is booked through May 2024. If you would like to participate or learn about the companies on our show, please reach out to Crystal at CryptoCannaVerse.com. Please note, I am not a licensed investment advisor, so please don't consider the show's content as investment advice. Conduct your own research and consult a professional investment advisor before making financial decisions. Today's show is being live broadcast across various platforms, including LinkedIn, Facebook groups, Twitter, and YouTube, with a total reach of 1.2 million. Our strategic network includes venture capital firms, family offices, blockchain and crypto hedge funds, business owners, Web3 launchpads, CPAs, attorneys serving high net worth clientele, investors, and angel investors. Alan, good morning. How are you doing today?
I'm doing great. How are you?
Wonderful. What is our Bible verse for today?
Our Bible verse for today, pull it up.
Alan is always amazing with our Bible verses. He has been my my co-host now since this inception. He's also the co-founder. He's been in financial planning for 18 plus years. And he has a reach, across the international reach, including, Hong Kong and various other Asian countries. Are you ready?
Yeah, I'm ready.
Okay.
Okay, so today's Bible verse comes from Deuteronomy 30:15-20. I'm going to read verse 15. See, I set before you today life and prosperity, death and destruction. For I command you today to love the Lord your God, to walk in obedience to him, and to keep his commands, decree and laws, then you will live and increase, and the Lord your God will bless you in. So this actually reminds me a lot about, I guess, our daily lives, right? Our daily lives, how we should listen to God and love the Lord and hear his commandments. And the only way you can do it is by doing your devotions. So I do my devotions every morning at Starbucks with a group of brothers and sisters. It starts at 7 o'clock and ends to about 8 o'clock. And every morning we go to Starbucks and review what we call a daily bread. So I think having our daily bread every day gives us a life of like inspiration and help us grow mentally first thing in the morning. So I'd like to share today's verse.
Thank you, Alan. I appreciate that. Today, the CryptoCannaVerse presents Patrick Camuso, CPA. Patrick is a seasoned professional with a remarkable track record in the field of cryptocurrency and Web3 tax and accounting. As a CPA, Patrick possesses an extensive skill set developed through hands-on experience and continuous learning. His in-depth understanding of digital assets has proven instrumental in delivering exceptional value to clients. Patrick's forward-looking perspective enables him to seamlessly navigate the intricate landscape of taxes, accounting practices, business dynamics, and technological advancements. With a focus on precision, innovation, and tailored solutions, Camuso CPA is committed to addressing the distinct needs of cryptocurrency investors and Web3 businesses. Our adept team excels in diverse areas from DeFi and NFTs to high volumes, transaction, and blockchain technologies. Notably, since 2016, they have been immersed in the crypto landscape, pioneering unmatched industry insights. Welcome, Patrick.
Thank you for having me. I appreciate it.
So happy for you to be here. So, Patrick, tell our viewers how you got into crypto and, why crypto CPA?
Well, I got into crypto pretty early on. It's sort of just a culmination of, I guess, my personality in my teenage years, being very interested in tax and accounting and how the financial systems work. Led me down a lot of rabbit holes, learning about the Federal Reserve, precious metals. And before I knew it, I found myself reading Satoshi's white paper back in around 2013. So, that's how I personally got involved in it. While I was doing that, I was working in the Big Four at Deloitte, and the group that I worked in was involved in financial reporting. So doing accounting for hedge funds, regulated investment companies, private equity companies. So really, then what I was doing was learning about crypto very early on, getting involved in it personally while building a professional skill set of doing financial reporting, dealing with large data sets of unstructured transactions, primarily back then, of course, with securities, but we would have to apply different tax adjustments to it depending on the nature of the investments. So, really building a good core skill set in terms of financial accounting while learning about Bitcoin and crypto and just getting involved very early on. And then basically, telling friends and family about it. And then around 2016 rolled around, I just started to basically realize not, just the technology, how it could affect us personally and as a society, but the professional opportunity involved in it and the tax implications associated with it. 2016, back then, there was maybe like 4,000, 5,000 tax returns that were filed with the IRS with crypto on it. And several of those were filed by my firm. So, that's when I really started focusing on it professionally through Camuso CPA. We were one of the first CPA firms to accept crypto as a form of payment because we were working with so many crypto native investors and mining companies. And so that's basically how I got involved in it. And then have been involved in it ever since, starting with working a lot with investors and mining companies that were primarily focused on Bitcoin, then to Ethereum. Then, we started to see a lot of ICOs and the proliferation of blockchains. So we started to deal with all those accounting and tax nuances. And then, DeFi, NFTs, and Web3. So really, I just started very early on in the space from just a personal interest and passion for it, and have just grown with the industry up to this point.
That's interesting. You said that you worked at Deloitte and you worked on cryptocurrency with Deloitte?
No, we were not working with crypto back then. It was just financial accounting. So working with hedge funds, mutual funds, those types of companies, but managing both the accounting and tax functions for them. In fact, like some very large funds we took from paper processes to paperless processes. So really what skill set translated over there into crypto was dealing with large unstructured data sets of financial information that we need to normalize and categorize and reconcile appropriately for tax and accounting purposes.
Gotcha. What's the big difference in working for yourself versus Deloitte?
I mean, they're huge differences, really. On the, when you're working in the Big Four, it is fantastic experience that I would never trade. But you're just usually working with different clients. I get to work more hands-on with clients at my own firm. I'm involved in, the sales and the content and more of the client management process at a much higher level. And the client sets are somewhat different. I'm not necessarily going to be consulting to like BlackRock or Apollo through Camuso CPA, whereas when you're working in the Big Four, you do work with like much larger types of companies like that.
What,
So
Patrick, I'm sorry, Chris, I was
please
going to
do,
ask
Jeff.
Patrick, what's been the biggest transition from TradFi to crypto, within the financial realm?
Well, I mean, when I was in TradFi, it was mostly within the Big Four, and then switching over to working in Web3. I would say like the biggest thing I encountered, especially early on, is just the sentiment or like the overall like knowledge and education a lot of times of some of the people that are involved in it, especially early on, like back in the 2016 to 2017 timeframe, people did not like to hear about cryptocurrency and taxes together. So just a lot of struggles just dealing with that. And in the early days, I would have people call into my firm and try to tell me that they should be able to do 1031 exchanges for Bitcoin to Ethereum and all these things now that just seem like sort of set up business. Back then were just huge issues. So just dealing with a lot of just initial hurdles just around the overall understanding of the tax implications of how cryptocurrency is taxed. And I mean, now to this day, that's still a problem that's just sort of maturing as the whole industry matures, I think, too, because now we still have an education problem, but it's around, the regulatory environment continuing to get more complicated as we start to see new regulations come out.
Sure. And I've read some headlines. I haven't been able to dig deep into it, but there's some regulations that have either recently come out or coming out around what you said, taking payments within crypto for your firm, which is fantastic. And we've actually just started making some of our first payments to our fund administrator, and the ease and just the instant, settlement, the ease of it. It's mind blowing when you do it for your first couple times and you're like, hey, this is the future. We figured it out. You're not dealing with wires getting stuck on Saturday and Sunday and ACH problems and everything that entails there. So what is that regulation? Do you see it coming to fruition, and is it going to cause all the problems that the headlines are saying?
I would say yes, although it is somewhat overblown. Specifically, what you're talking about is Form 8300, which is just going to be an informational reporting requirement. So if you're acting as a trader business and you receive over a certain threshold of US dollars equivalent of a cryptocurrency, you're going to have informational reporting requirements, similar to how if you have foreign banking transactions, you may have informational reporting requirements. So it's not going to be like an extra tax associated with that form, but there are these stringent reporting requirements that come with steep penalties if they're not met. Now, that is supposed to basically become effective as of January 1st. That's why you're seeing a lot of things in the headlines with it right now. We still need some more guidance from the IRS in terms of regulations related to that, and also some updates to the Form 8300 most likely. But basically right now, companies should be acting as if this is effective January 1st, and we're probably going to see more information from the IRS related to this within the next week or two as well. But it's supposed to be effective as of January 1st, and now we're waiting for the regulations from the IRS. So that's going to require people, if you get paid over 10K in crypto, it's going to require you to report basically KYC information of the transaction from the person who paid you. So that's why a lot of people are unhappy about it, because basically what the IRS is requiring is you to KYC anyone that pays you, which goes against the nature of Web3 and what people want with decentralization and anonymity. But I would say overall, what we're looking at on the regulatory front with the IRS, with this Form 8300, with the proposed broker regs, and even at the state level with sales taxes, there's going to be a lot more KYC requirements with non-custodial wallets.
Okay, so follow up to that real quick. The onus is on not the payee, which would be us paying our fund administrator, but the fund administrator receiving the payments to create the form?
Yes, would be if you receive a payment, yes.
Okay. Got
And
it. Thank you.
it's also unclear on LP distributions and contributions, what that will look like in terms of reporting requirements. This is really high level with the information that we have on it. So that is something that is still unclear. You know, if we're looking at contributions and distributions from an LP, is that going to be included in Form 8300? Right now, I would, you know, on the safe side, assume yes until we get further clarity and make sure that we have the data on all these individuals in terms of the KYC information, so you can fulfill those reporting requirements.
Sure.
Those are great
Now,
questions. Go ahead, Tom.
Now, can I ask Patrick? So I've been following Patrick for some time, and I greatly appreciate his thought leadership on a lot of these issues that are kind of becoming at the forefront. But something related to payments that I constantly have to try and explain, I'd like to hear him just weigh in for everybody that's watching, is this idea of don't get yourself trapped by, if you're going to start accepting payments, by not settling your tax liabilities promptly, or at least take your cut when you can, because should the bear market erupt, you will not have that luxury. You'll be liquidating your crypto assets at values that will make you cry. So I'd love to hear him expound upon that a little bit.
Yeah, that's a great question, Tom. I appreciate it, because that is something I harp on a lot, because I see this kill investors' portfolios and kill businesses' bottom lines basically each market cycle. And this won't be any exception. And on the flip side, when we do get new clients and we're able to proactively tax plan with them and work with them, there's been many I've been able to warn that come back to me when the bear market comes in a great mood, feeling very thankful, because, you know, they have cash flow to get them through the most important time when you're dealing with this, you know, these market cycles. And basically, you know, if someone is, say, getting paid in Ethereum or you're mining Bitcoin, you're going to be having gross income that's going to get taxed at the fair market value on the date that you receive that crypto asset. And during the bull runs, when everybody is euphoric and feels like the price is never going to go down, they're not inclined to liquidate any of their gross receipts. So, you know, there's the treasury management conversation, which I don't like. Even before that, we need to get into the tax conversation. And that is that, like, when you're receiving these, you should be doing tax projections on a monthly, quarterly basis, and taking the Ethereum that you receive, at least the tax liability, and moving that to USD and paying your quarterly estimated taxes. Because inevitably what will happen is there's going to be a bull market that comes. And if you're planning to pay your tax liability out of Ethereum, and then Ethereum gets cut in price by 50% because we have a bear market, now you're looking at, you basically doubled the amount of Ethereum that you're going to pay in taxes because the price got cut in half and you're paying your taxes in USD. So I always stress, as Tom is saying, to basically remove your tax liabilities from validity risk associated with the market. And you do that via keeping your accounting updated and doing tax projections, so you can make your estimated tax payments.
And one quick follow-up to that, since I deal with many smaller clients, one thing that's also kind of related is this idea of kind of commingling their business and personal. And this really starts to become a problem with that, because now they get themselves caught short and they're struggling to try and figure out how to, you know, make a path forward. And it's all because they don't quite understand that this commingling is not something that is very advisable. So I'd love to hear Patrick just comment on that briefly as well.
Yeah, no, that's another fantastic point. And that is something that I see a lot too on both the investor side and the Web3 side with businesses, sort of in different forms. On the investor side, a lot of times, you know, they'll commingle family and friends funds together sometimes, you know, to make investments on their behalf. On the Web3 side, you'll see a lot of commingling between business and personal wallets, especially when you're dealing with a newer company, like you're saying, where maybe when you're first getting things going, you use one of the founders' wallets for this or that for whatever reason. And sometimes there are reasons where you want to use legacy wallets. But the problem with commingling takes many forms. Number one, the accounting difficulty, because once we get into commingling and you have transactions that are personal and business, there's no way, no matter how long, we investigate at their scan, we're going to be able to tell if it's a personal or business transaction, if they're all just mixed into one wallet. So it's going to require a lot more input from the company, a lot more manual work in terms of splitting that information, if that's the approach that you take. But then you run into other issues where, if you're commingling company and business funds, or if you're commingling family and friends funds together on centralized exchanges, now you have 1099 issues that people run into, to where, they took company funds and they put it on a personal exchange, and now they're getting 1099 reporting in their personal name. So there's these issues of just the accounting issues that the commingling is going to cause, in terms of just, it's all going to be a jumbled mess, and we're going to have to take some methodology, some step by step separating that out, and then we're going to have to deal with the potential tax consequences associated with it, if there's any centralized exchanges that you commingle funds on, especially.
Thank you for elaborating on that.
And just one quick thing that's related to that is, what about like a husband and wife who have separate portfolios?
Yes. Well, that gets a little nuanced, because what we have to consider there is, like, overall, it's better still, I believe, not to commingle and to do the taxes separate. But it sort of gets into like how they have their marital affairs and their tax filing set up. Because if you are filing jointly and you are commingling, it's sort of like, marital funds being in a shared bank account. I don't see it as big of an issue, because like the net tax consequences aren't huge. But one thing that I have seen just in probably like the past couple months is a lot more inquiries from divorce lawyers for like digital asset accounts.
Been there, done that.
Yeah, so I like that's starting to increase a lot. So it's probably better to keep it separate at the outset, but it starts to get into, how are you filing your taxes? How are you managing your overall like marital funds and finances and stuff like that.
Thank you, Tom. Appreciate that. Thank you, Patrick. Joseph, we have a question.
Hi guys. Hi Patrick. I'm not too bad. Sorry for taking so long, by the way, Crystal, to get back. The shoulder is doing much better finally.
Wonderful. Good to hear.
My question, Patrick, what would your opinion be on the concern of as far as commingling those funds in reference to piercing of the corporate veil?
Yeah, absolutely. I think, when you get into commingling, if it's in relation to an LLC and your personal funds, there's definitely a risk associated with that. And you likely are going to pierce the corporate veil, and it can affect the liability. It somewhat gets into more of like a legal rather than a tax question, where I wouldn't be an expert on it. But anytime, I'm working with anyone with an LLC, I do stress maintaining the corporate veil. And the number one step to do that, after establishing your articles of incorporation and your EIN, is having separate and distinct accounting records between that LLC and anything else, any other company or you personally. So yeah, I think it's fundamentally, if you commingle, it's going to create tax issues, accounting issues, but even like you're bringing up, it also could bring up legal issues as well. So that's a good point.
Yeah, I brought that up specifically with a specific case in mind of I work in the cannabis industry, and a specific case in mind on the West Coast of where a CEO didn't have a board of directors and commingled funds, and that allowed for the piercing of the corporate veil. Not separated or distinctly separate himself from the company due to the lack of a board and the commingling of the funds.
Yes, that's why the management of the funds on chain, I think, is crucial, especially when you're getting into into companies. And while we're on the subject of liabilities, I think another interesting thing to consider is how you interact with DAOs as well, because a lot of these DAOs should be. I was just doing a presentation on this the other day. Most DAOs, they should have some sort of entity structure. And some do and some don't. And to the degree that some don't, the question of liability arises for any members that are involved with that DAO, not just tax liabilities and the accounting nuances, but also, legal liabilities as well.
Yeah, federal tax liabilities. Yeah, 100%.
Yeah.
And my second follow up to that was, as far as when you were mentioning, let's say that plausible situation where Ethereum's value is cut in half, and then you have to pay taxes on what your earnings were. I know I was going to say logic would dictate, and common sense is not when dealing with the.
So it's not logical.
Dealing with the government, but wouldn't the logical thought be able to be that you can argue I didn't earn that much? Because
no, because your tax, like if you get paid in Ethereum, like the one time each month, you're taxed at the fair market value on that date. So say if you get paid in Ethereum when it's 10K and you hold that full 10K, and then you go to pay your taxes when Ethereum's 5K, you're going to be paying double the amount of Ethereum to cover your tax liability. So what I'm trying to say is, like, when you get that 10K, estimate what your tax liability is off of that, and at least get it to Stables, if not making a quarterly estimated tax payment. Because what I see invariably is each cycle people come to a bull market and they're looking to pay out of their portfolio, and they're just shocked by what it does to their portfolio or what it does to their business profits. And when you're in that scenario, it's coming at the worst time in a bear market, usually too.
Exactly. Usually it's when it rains, it's pouring, and patients and clients usually, if you're using crypto, change it out immediately so that way it's to stable. Because I didn't even think for the tax purposes that you mentioned. That's why I asked. But it makes complete sense now.
And there's just the managing the basic tax liabilities, and then you get into just like overall portfolio and treasury management, and what they want to do in that regard. But the main thing I try to stress is, like, don't expose the tax liabilities, and then after that, start to develop a broader practice around how you're managing your portfolio or your company's treasury.
Taxes.
Thank you. Thank you, Joseph. Those were great questions. Patrick, there's so many different facets to the crypto, blockchain, Web3 industry. What is your favorite area to work in?
I mean, I just love crypto in general, and just being on the forefront of these emerging topics. I would say, like, the two, biggest groups of people that Camuso CPA serves would be what I would refer to as digital asset investors. So, these are going to be individuals that are, have complex portfolios, usually, that are involved in DeFi or investing in a lot of NFTs during the last cycle, or just in general are investing in crypto and are higher net worth. And then the other big group I would refer to as Web3 companies, which basically, are going to be companies that are transacting on chain, and usually are, going to be more like blockchain native companies that are raising capital on chain, paying employees on chain, getting paid on chain. But overall, our firm is 100% crypto focused. So usually, if you're transacting on chain as an individual or a company, we can usually help you. And, in the cases, like you were saying, like in terms of like partners, in the cases of if we do need to bring someone in with expertise outside of our expertise, because you're in some industry vertical with some nuances, maybe like a cannabis vertical, then, that's when we would bring someone in that has, that specific expertise. But in terms of serving accounting and tax needs with on-chain transactions, that really is like our bread and butter. And we do it on the investor side and the company side. I would say on the investor side right now, a lot of what I'm seeing and doing is just, dealing with people that, have not filed for years, believe it or not. And, a lot of times they're coming as a result of tax notices or some sort of bottleneck to do with their taxes that, makes them have to report. It's not uncommon for us to be filing taxes back to 2016, 2017 for that time frame, like every week. And, on the Web3 side, a lot more of that. There's a lot of cleanup involved, but there's a lot more that we can do proactively in terms of getting accounting and systems established, helping to select the right software vendors and set up accounting systems, get tax plans in order, avoid a lot of these tax pitfalls. So, those are the things that I really like to focus on.
That's good to know. Jeff, you have questions?
Yeah, Patrick. As the government's trying to get their arms around this, which is always interesting, and the IRS, which is always even more interesting, which you're in the middle of that battle and changing environment all the time. One of the interesting battles that we see or have seen is around staking. And right now, currently, I think our portfolio is about 45 to 55% staked. We're getting somewhere around a 9.6 average yield right now. So absolutely fantastic, right? For assets that we would hold for years, hopefully. It's like renting a space in our garage. We often equate it to my neighbor who wants to put a shovel in my garage. I wasn't going to use that corner. He's offered to pay 9.6% of my mortgage. And if that asset raises, then that yield goes up. So extraordinary in the space. But part of the problem is very similar to what you're talking about around payments. Right now, the government taxes as though it's income. So as we get these like titled, if you will, or assets, the payment comes in the form of assets. If we're paying income and the market does go down, that's not our projection for 2024, but if the market does go down, the same compounding effect on the negative side comes around. And so a lot of our industry is arguing, hey, we shouldn't be taxed as income. We should be taxed on these assets as we sell them down the road, right, for long-term or short-term taxable gains. And that would certainly be where we would weigh in on that conversation. But right now it is taxed as income. How do you see this playing out? Is there any wiggle room in there? Is there folks lobbying for a different taxation around it? What do you see?
Well, look, like this is one of many issues that I think is going to be controversial for years to come, and we'll have to see how it plays out in tax court. So, there's sort of like the higher level tax discussion about, there's no counterparty related to the staking rewards. Therefore, it shouldn't be treated as income. It should be treated as basically you're creating a new piece of property. Therefore, it shouldn't be taxed. That's basically like the crux of the argument on the side of having staking not being taxed upon receipt, just having being taxed upon sale. Similarly to how like a farmer, if they produce something in their field, would only be taxed when they sold it. So that's the argument to not have staking be taxed. The argument against it is that there's basically constructive receipt of an asset that has value, and when you get an asset that has value, you're basically providing a service to the blockchain more or less with the staking by securing the blockchain. Therefore, it should be taxable upon receipt. So those are the arguments, and that's what's going to have to get litigated out in tax court. When I'm dealing with clients at Camuso CPA, I lay out both sides of that to them, and then I explain the more likely to not standard that we have to meet when we're filing a tax return. And that's really where this comes down to, and where a lot of the gray area comes down to, where people, that you want to like take that more aggressive position on your tax return, it's going to come with risk, and it likely should require some, disclosures, because it's probably, not more likely than not that that's going to be the IRS's position. You're probably going to want to get some tax lawyers involved writing an opinion on that and be ready to defend it in tax court. So, I would say, like, when I explain that, 90% of the time, 95% of the time, people want to take the more conservative position with, that being faced with that prospect. Now, we see the Jarrett court case. That won't be the last one. There's going to be people that I believe are going to want to sort of push this. I think there's even, arguments in tax court cases about the taxability of mining, which, that's even more, that was decided even before staking. So, yeah, I think these things are going to be pursued. I think I understand the argument that they're making with the staking, that it's creation of a new property. There's no counterparty that's paying it out. I think it's an interesting argument. It's just about, is that going to be what becomes tax law? And is that what the courts are going to decide? I think it's an uphill battle, just because of the overall tax implications, and there is, I think, an argument for the constructive receipt side because, when you receive those staking rewards, you could sell them, and there is a market rate. So there's that side of it too. So I think there's two sides to the argument. And this sort of goes into like my approach a lot of times when I'm serving clients is to try to present both sides of the argument to them and try to have them really understand like where the tax landscape is. So it's not just like this broad brush gray area. You really understand both sides. You understand what's more likely to not. And, if we want to pursue the more aggressive route, making the, appropriate disclosures and being prepared for that, which most people are not inclined to do, at least right now.
Sure. Thank you.
Do we have any further questions for Patrick?
I have one. So related to that though, is this idea, and it's become actually kind of a nuisance, is this idea of airdrops and how they're taxed. I have many clients that all they do is beat on me constantly about why do I keep seeing all this garbage showing up in my wallet? And, I don't want to pay tax. There's just a real serious disconnect on their expectations on how this should work. And yeah. I think it is kind of related to staking because this is just stuff that mysteriously shows up. There is no counterparty to any of this stuff for the most part, or if there is, they're scammers and whatnot. And, you can't even tell the difference between a valid airdrop for real reasons compared to one that's just a total scam.
Yeah. And, that's the problem with a lot of these blockchains is that like Web3 in general is that a lot of these transactions, they're just push transactions. They don't require you to accept them. You just wake up and you have an airdrop in your wallet, basically. But, the IRS and the regulations that they've set forth taxing crypto as property just doesn't really take into account that consideration. And that's why all these tax reporting requirements come up for things that sometimes like related to an airdrop can basically be outside of your control. So yeah, like right now, airdrops, just like any other income that you earn, is basically going to be, taxed upon receipt according to the, current, tax structure and regulations. But I do agree, it's an issue. Someone can get an airdrop and not realize it for 3 months, and then the price got cut by 50%. With the spam airdrops, that is more to me like an accounting annoyance because you have so many spam tokens, but they at least don't have value. So there's really not ultimately a tax implication to those. They're basically just disregarded because, yeah, they're, treated as income, but it's zero value basically. But I do think it's an issue, if someone really has to stay on top of their wallets. And it's, one thing I see a lot with clients is, especially when they first start out, especially on the individual side, there's not really like a good wallet hygiene, good wallet management. There's tons of wallets. And you gotta make sure that any wallet that you set up, you maintain financial responsibility over, and you continue to monitor and stay on top of all of your tax reporting obligations, because they just be getting more stringent here in the future.
You're on mute, Crystal.
Wonderful. Do we have any other questions, comments for Patrick?
Yeah, I'll ask another question. Patrick, I think there's a few, and I might be wrong here, but I think there's a few countries that are being very aggressive in their taxation for the investor, putting it on their side, if you will. And what I mean by this is something like, kind of almost money in, money out. So if I put money into MetaMask and took Ethereum and exchanged it for something else, I don't have to worry about that transaction. It's almost fiat in, and when fiat comes out, that's when the taxation's recognized. Yeah, I mean, just absolutely.
I mean, that would basically, the way we would see that is if they did some sort of like-kind exchange provision related to crypto, probably. So then, anything that's within crypto is going to be taxed like that. although that would be nice, I don't really foresee things going in that direction. I mean,
Right.
if you look at, the industry itself, why it was established and what its stated goal is, it's not a surprise that, the tax system that gets established and sort of just like the positions of some governments may not be, I think, fully favorable to crypto overall. When it's can be perceived as a threat to the US dollar and all these other things. So it's not like a lot of these regulators, um, you know, I just don't think are going to want to allow something like just saying like, give us a like kind exchange provision and just have all the crypto be a free for all. That would be awesome and just do it on cash outs. But I just see it going in the opposite direction where,
Right.
You can't even get like a de minimis exclusion for like $100 purchase at a convenience store with crypto. Never mind like a like kind exchange. I would like to just see something I think that would help with adoption is just like a basic de minimis threshold. So people can go and spend crypto for $50 and have it not be taxable. Because even right now, like small things like that are taxable, which, help like hurts the adoption of really using it overall, I think, as like a payment method. So I just see things going in the opposite direction with a lot of that. Although, we did recently have the accounting standard changes with FASB, not exactly tax related, but I do think that was something positive for the industry because we're going to see companies now, their balance sheets representing the true value of crypto rather than cost less impairment, which could lead to long-term adoption. So there's some positive things, but overall the IRS looks like they're taking a very aggressive stance between Form 8300, the proposed broker regs. It's just looking like they're taking the opposite stance of like you said, some of these other countries with that setup of just having it basically be on USD cash outs, that is like very favorable for the taxpayers in that country. So they're taking a very favorable stance there.
What country is that, Patrick?
Oh, I thought you mentioned one. I'm not.
Yeah. And that's I just seen a couple headlines quickly, and maybe it's a little bit of posturing from certain jurisdictions, but
Yeah,
it was
I've
interesting.
seen some headlines recently with Japan. They, to my knowledge, have fairly strict tax laws, and they were looking at maybe making them a little bit more lax. I'm not up totally on the details on those, so I don't, if I'm misquoting there, don't hold it against me.
Right.
And we have a question from Tom.
Yeah, so Patrick, so sort of related to this, one of the interesting things is, I deal with clients actually around the world, and I did run into, I think something like that exists in, I believe, the Netherlands, where they're more concerned with the fiat side, when it's actually kind of back into their home currency. But tracking back on this a little bit, another area that I think needs to be investigated, or at least expectations set better, is this issue with wash sales. So there are countries that actually are pretty aggressive about that. For example, I have a client in the UK, and they're pretty darn serious about their wash sales. It's not called a wash sale, but where do you think that's going to go? I mean, it's right now we don't have that rule, but bots can trade real fast, and
Oh, yeah.
it's a you can have 10,000 transactions in a heartbeat.
Oh yeah. Well, that was actually one of the things when I was in the Big Four dealing with those large data sets that I was talking about. That was one of the things we had to do was wash sale adjustments. So I'm very deeply familiar with the accounting burden that will create on taxpayers if we do implement a wash sales rule on crypto. I mean, as it stands right now, there's a lot of tax implications to when the IRS had crypto be taxed, that had Bitcoin and other cryptos be taxed as property. I would say most of them went into the favor of the IRS because it made every transaction taxable, and it created a lot of these issues with the validity and all the transactions. But one thing that went, I guess, in the favor of taxpayers is that wash sales currently only applies to securities. Now, outside of just the wash sales regs, you have to also consider economic substance with the transactions, and I do stress that to clients as well. Just outside of basic wash sales, we still have to have economic substance to the transactions to have them be valid for tax purposes. So I think those are the two considerations. But as it stands right now, it's as long as there's economic substance to the transaction, which, it's hard to take a position, I think, for the IRS that there's not to most transactions just because of the validity associated with most assets, especially microcaps. Wash sales are a great tool, especially when you're going from bull to bear. And clients can stack up losses and use them for the next bull run. But it is probably one of the only tax benefits you're getting as a crypto investor. And there's been many headlines and many attempts to apply wash sales to cryptocurrency. They say close the wash sale loophole. It's not really a loophole, it just doesn't apply to property. So they're going to have to have some regulation that's going to specifically apply wash sales to cryptocurrency, or they're going to have to create some new provision associated with it, or they would have to start pursuing economic substance, which I think is an uphill battle. I think it's more likely than not the taxpayer would win out in that regard. So yeah, I think wash sales are a great tool as long as it's available, but it's eventually it could change. We've already seen attempts at that.
Patrick, what do you think about Bitcoin ETF? What's going on with that right now?
I'm excited for it like everybody else. I've been in this a long time, just like I said, like even personally before professionally. So I think the Bitcoin ETF is going to, bring more institutional adoption. It's going to bring in a lot of financial advisors working with, their clients on Bitcoin. Bring a lot of attention to the space. We have the halving coming up. So I'm excited for all of that, like everybody else, and excited to see what it does for the industry in terms of adoption and, sort of just see where it goes.
Jeff, how is that going to change your business?
It's not. It's just going to make it more exciting. As Patrick said, that it really, to us, it's almost a stamp of approval, or at least at a minimum acknowledgement by the U.S. government that, hey, this asset exists. It can be regulated. It can be controlled by not honest institutions, but institutions maybe. And it allows those institutions to now, they're legal to check off and say, hey, we can invest in this because this is in place and this is in place. But it also, more excitingly, it allows, my neighbor that can't afford to hire us, but wants exposure, doesn't know how to spell wallet, but now can put a little piece of his IRA into it. And his financial advisor can now profit and make money off of it, which before they couldn't. So, of course, they're going to shun it. So all these pieces instantly come into place, which raises demand on a static or, on a infinite supply. And you're going to see prices, in our opinion, dramatically rise. And it'll start just like every cycle and everything does. Everybody's first investment almost to a T is Bitcoin. Then it moves to Ethereum. They get excited and it trickles down into the other seasons, the large cap season, altcoin season, and the small cap where we play. So we couldn't be more excited. It's perfectly timed. We're now just over a year into this new equity bull market, just over a year into this new crypto bull market that people are just starting to wake up to. They're still skeptical about it, but we think 2024 is the year that the crypto bull market becomes loud and acknowledged with the trend, as Patrick said, the halvings coming in, hopefully the ETFs, new regulations, new IRS adoption, whether that's kind of good or bad. They're saying, okay, here's the rules of the road. Here's how you play this game. The referees are on the field. And, we're perfectly positioned. We're seeing excitement. All the folks that were not interested in, maybe joining us or joining crypto when Bitcoin was at 20,000, we said, hey, we'll probably start getting those calls at Bitcoin 33 and 35. Really, they actually started coming in actively at 38 and 42. And so we know all those people that held off, when it was the best time to buy, are now starting to see, hey, this is starting to make sense for all those reasons Patrick and I just talked about. So we couldn't be more excited. Our forecast for the S&P 500 this year is plus 17%. We haven't developed our forecast yet for Bitcoin, but we nailed it last year, and we think it'll probably be triple digits. So in the next week, we'll start narrowing that down, and maybe we'll get to share that on your next podcast.
Wonderful. Thank you. We have time for one more question, Tom.
Okay, so Patrick, so 2024 is kind of a whole new year, and one of the passion things that I think that you've been beating the drum about is sales tax on NFTs. So I have made it my mission to educate, and so far, a lot of pushback from the NFT investors that I deal with. They're not happy. They're especially not happy about the possibility of back taxes and so forth. So, it's a great opportunity for you to go and tell everybody what you know and what you think.
Well, I appreciate that, Tom. And yeah, I guess as you're aware of, I've been monitoring this developing state tax issue since its inception. We've really seen Washington State out ahead of this the most out of most states in terms of the guidance that they've given. And basically, NFTs in the last cycle just was artwork. In the future, it can basically represent ownership of many different things on chain. So, I understand that the NFT tax laws, just like the proposed broker regs, just like the Form 8300 requirements, none of these tax requirements people are going to like in the future. These wallets are going to have to be KYC. There's just going to be too many tax authorities that are going to basically require it. So in the future, if people go to purchase an NFT, they are going to be paying sales tax on it in states that are applicable. And the reason being is because if you look at the guidance from states like Washington in particular, along with others like Pennsylvania, Wisconsin, they're including NFTs in their definition of digital products. Digital products have, a history of being taxed in these states for 10 plus years with the Wayfair decisions, and they're going to apply these taxes to crypto. And for companies that don't collect it, like if you're selling NFTs in Washington and you're a company that doesn't collect NFT sales taxes, and you try to claim it's because you don't have KYC information, all of the taxes fall on you and they're default to your state. And then you're going to be paying them all out of pocket. And this is a tax usually collected at the point of sale and passed through to the customer. So right now, as it stands, if you're in certain states, Washington, Pennsylvania, many others, and you sold NFTs in the past years, you have this retroactive sales tax exposure already. And if you've sold to customers within those states, you technically have it too. And the worst part is the flip side of sales taxes is use taxes at the individual level. So there's many people that are, filing capital gains for their NFT purchases in a state, and then they're checking that they have no use taxes due. But maybe they're in a state where, they purchase NFTs and they should have use taxes on those NFTs. So it's creating this huge tax conundrum that's just outside of any federal taxes. It's going to be at the state level, and it's mainly going to, I think, be enforced at the company level because that's historically how we see sales taxes being enforced. But ultimately, it's going to lead to all the marketplaces, all these NFT sellers having to collect the information that's required to collect sales taxes. And basically, what you need to collect sales taxes is a full address of the taxpayer. So your address is going to be associated with your wallet if you want to pay sales taxes. And if the company says, I don't want to do that, then the state's going to basically come after them and say, well, then you pay all the sales taxes out of your profits to us. And that's where the rubber's going to meet the road. And if you want to be compliant and be in Web3, you're basically going to have to collect sales taxes, just like you're going to have to comply with the proposed broker regs and anything else. So I do think, like, from a broad regulatory standpoint, there's this huge issue of just KYC and information collection versus an industry that wants to be decentralized and not require KYC. But the issue for NFT sellers and for people that are upset about the proposed broker requirements and all these other things comes down to the fact that these are basically centralized companies selling these things, and they're going to have tax reporting as a requirement of that, and something's going to just have to change from the regulatory standpoint for that. So right now, I think moving into 2024, sales taxes on NFTs, If you look like 10 years ago, there was the proliferation of e-commerce, and we had the Wayfair court decision that had sales taxes across state lines. There's going to be what I'm calling like a Wayfair 2.0, which is basically sales taxes on NFTs and the whole industry having to, come into compliance with this new tax requirement.
I got one.
Well, thank you. Well, let me just thank you for that. My home state's Pennsylvania. This dropped on my radar about a little over a year ago. For the most part, my sales tax, my use tax calculations were kind of what I called de minimis. They weren't that large, so it fit into the annual, the annual figure, but could very easily grow outside of that. And it's actually a recording and analysis nightmare for the most part. And having had the pleasure, or should I say mispleasure, of participating in a couple of sales tax audits in my lifetime, I don't recommend people fool around. If this stuff starts to become serious, they really need to get their act together.
Absolutely. And
Patrick,
get heating up in the future.
Yeah, Patrick, I'm sorry to interrupt you, but we're going to have to end the call. Thank you so much, Patrick, for joining us today as our guest speaker. And thank you, Jeff. I appreciate you being our guest co-host, and appreciate everyone on the call today being thought leaders. I'm going to go ahead and have Alan wrap up in 30 seconds with a quick prayer. And then if you guys want to stay on the line to chat for 15 minutes, that would be fine as well. Thank you.
Yeah, stay off there a little bit. Okay. All right, let's bow our heads and pray. Thank you so much for everyone joining. Let's pray. Heavenly Father, thank you so much for just great people coming into our show, Patrick and Jeff being our co-speaker at our CryptoCannaVerse show to help us understand and teach us and inspire us and help us grow in our understanding and taxation in regards to cryptocurrency. We know that this technology is here to stay. And the more that we learn about this technology and how it's going to be regulated and how taxation is going to be involved, I think all advisors and professionals will start adapting and start learning the rules of taxation in regards to crypto. So continue to help each other out to grow our knowledge into this space. And we thank you for everything that you have provided for us. In Christ's name, Jesus' name, pray. Amen.